Welcome to our Twitter space today. This is our first Twitter space with the CFO. It's about breaking down banks' earnings. So for perspective, every company has a financial year, and the financial years are broken down into 4 quarters in a year. Banks are supposed to report at least every quarter. The first quarter ended in March, the second quarter ended in June 30th, and the next quarter ended in September 30th. What we are doing is to host the CFOs and management teams after the earnings calls. Then we are able to look at the results and also be able to explain what are the key numbers and how they've changed over time. Today, we are very lucky to have the CFO of Bank of Kigali, the BK Group. We're going to dive right in and welcome her. Natalie, you can say hi and tell us a little bit about yourself. I know you're in Nairobi, so you can say how you're finding Nairobi.
Thank you, Mokaya and the Mwango Capital team for hosting the call. Yes, you're right. I'm very happy to be taking this call today from Nairobi. Beautiful city, as you know, very busy. And the traffic has been quite nice to us, to be honest. We've had a couple good meetings since yesterday. And the weather and everything and the people have been quite lovely. So I'm having a good time. Thank you.
All right. We'll start off by asking maybe you can tell us a little bit about your journey so far that led you to being CFO of BK Group for 6 years now.
Thank you. That's a good one. When I look about my journey so far, it's been one that I would say has been quite successful. So you look at starting my career just over a decade ago in the UK when I finished my studies. So I've always been passionate about financials. I graduated in accounting and finance. I pushed for a first-class degree, was recruited immediately after university and mostly worked in accounting and finance in retail and leisure companies before returning home in 2011. Since then, I've worked with Bank of Kigali. First joined the bank when Bank of Kigali IPO'd. So we listed on the Rwanda Stock Exchange in 2011, September. Just as I was joining, it was quite interesting to start with the journey of being a listed entity. So now we're something of a focus back then, investor relations and so forth. And that's how I started with the bank. It has been very happy days, I would say, when you look at the journey, going into more numbers as the CFO, cross-listing in Nairobi and so forth. So it has been a couple of capital raise and a lot of learning along the way in terms of perfecting my passion for numbers.
Maybe you can tell us a little bit what it takes to be a CFO. What does a CFO do and how does your day-to-day look like and what's usually the typical journey to being a CFO?
Typical day-to-day for me would be looking at, first of all, what is it that you own? So what's your assets and who do you owe it? Where did you get it from? And that's where the liabilities will come from. So you have the management and maximization of the financial part. Where do you place your asset to get as much as you can because you need to pay it back at some point to the people who gave you these assets. So they generally on the liability side, for a typical bank, you'd have the customer deposits or the bank deposit, and then you have your shareholders' equity. So having good management around your asset, which is cash and loans, typically for a bank, will give you the profitability that is required to pay to manage the human part, which is your suppliers, your regulators, and various stakeholders, and staff being one of the key one on your profitability statement, returning now good returns to the shareholders who are long-term investors. So you look at management of people and management of financial risk, making more what you have and making sure you gain more customers and retain market share your day-to-day. So strategy management at a CFO level, but in terms of finance perspective, you need to look at every penny counts. So who do you pay it to and where is it coming from? Are you doing the best you can to manage risk in terms of fraud and errors and so forth?
One thing that I know is that banks are some of the very highly regulated entities in the world. Central banks are always paying attention to what you own, who you owe. So cash flow management is also a very integral part of that. So why are banks held in that high regard? At the same time, why are they very highly regulated? In your day-to-day, how does that look like in terms of making sure that people's deposits are actually kept well?
It's highly regulated because of the importance of financial systems in our economy. So when you look at movement of funds, without strong regulations, you would have a lot of risk. So there will be no sustainability. So you're looking at Long term, it's really working with various players. So that would be mostly global players to manage, how do you regulate a market, especially ours that is quite young. So you are looking at GDP, banking asset to GDP still is growing fast, but it's still lower than you look at developed market. So regulation is a big part. So central bank will come in very closely monitoring, of course. Any weaknesses will be signaled by complaints. You'd have system failures that will signal a higher level of risks. But generally, a successful company like BK Group will generate more cash in its daily operations, invest it in various instruments that will be, securities, and hold good relationship with other banks to hold any other required level of liquidity that the central bank will put in place. Other key regulators will be the likes of revenue authorities. Are you paying your taxes on time? Are you complying? And of course, the suppliers are also very important stakeholders because they offer us various services and deliver goods to us. And if they are not managed efficiently, then you have the reputation risk and also delays in your operating activities. So the kind of daily operations and management on the finance level.
What have you learned in the process of being CFO of a bank? How is that different from the kind of institutions that you've worked with before?
Thank you. I would pretty much say that for finance, although industries will be different and they'll have characteristics that are different when you look at, let's say, a leisure or retail sector with a banking, because banking you're managing more, the biggest asset will be loans, where for others will be different. Generally, for numbers, it's always about what you own, which is your asset, and who do you owe it to, and the liability, and you have income, expense, and your profitability. So it cuts across all industries. You will manage your asset very well to generate as much as you can from your asset in terms of income. You will efficiently manage your expenditures so that any excess or any inefficiencies are not within your day-to-day operations. And then you return to the owners of the company, who are the shareholders in terms of capital. And then it means you continue to reinvest the capital that they have trusted you with. So it's generally the same across industries, just that the types of asset or liabilities that you are managing will be specifically different. The regulators will be different in various sectors. But you're looking at, in terms of finance, you know where your assets are in terms of identification. If you have a vehicle, you know where it is and where it came from. It means you owe money to a supplier, you owe money to your tax authorities, or you owe it to the owners who are the providers of capital. So it's always about what you own and who do you owe it to, and how much are you making in terms of operations. And of course, generating cash, because if you can't generate cash, it means you are eating in your cash ability, and you will run out of business soon. So who are your customers becomes very key in terms of income, and who are the people who are helping you generate this income becomes your staff and various other service providers. And these are key. So it's management of human capital as well as the asset and liabilities.
Give us a picture of how a typical balance sheet for a bank looks like.
A typical balance sheet you would look at for a bank and the financial institution, because you're looking at bank being a subsidiary and you have other subsidiary in the financial service space like insurance and asset management and the likes. Generally, you would have your assets. You target to have the highest yielding asset. By yield, I mean the asset that generates the highest return. And that for a bank will be loans. And you will look at loans in terms of management of risk. Who am I giving these loans to, and the ability to repay the loan, and the time frame that they're taking the loan for. Then, as you're analyzing your pipeline and you're looking at the growth prospect, you will then have your excess liquidity invested into the next type of asset, the lowest yield category of asset. In our market, you'd have the government securities and the like, so corporate bills and bonds. They also generate good returns. They are usually short term, because because they are giving you a lower yield, you would want to wait for a good pipeline and you not want to lose on those opportunities. You also have the requirement to hold cash for your day-to-day operation, a customer who want to come to withdraw. So good management of your liquidity on a day-to-day basis is also extremely important. On the liability side, so the balance sheet will be made up of asset, liability, and equity. On the liability side, customer deposits. As a bank, you are an intermediary. You are managing deposit, which is customer fund, giving it to other people who need it. So, for example, you'd have your current account with us, and we will invest it in loans because we know generally that you will be making your payment with a particular pattern, and we will mostly bank the value chain. So even when money moves from one current account, it goes to another. So you manage the liquidity from customer deposit with also some good relationship on banks deposit. So banks generally also hold money for other banks. So you have liquidity from other banks. Then you go for your payable. So people you owe money in the near future. Those are usually people who have offered you services or delivered goods. Those will be suppliers. It will be tax payment that are due and so forth, like every other company. So you have your liability in form of other payable. Account in transit will be another. So as money is yet to clear to a client current account, you'd have it sitting in a transit account as a payable. And the last on the balance sheet will be your shareholders' equity, which is the capital that was injected initially for you to start business, in addition to what you have made historically, which is your reserve and return earnings. And these are generally common across most banks' balance sheets. You would have what is usually referred to as off-balance sheet item in case mostly of financial institutions. So a loan will be something that is on the balance sheet because money has moved hands. So it has moved from the bank to a client as a commitment to a client account. The off-balance sheet will generally be promises that you've made to your client that you will honor in the future. So these will be generally in forms of LCs, back guarantee. So future commitments, you will hold them as off-balance sheet. And these are generally what you find common for a bank balance sheet. So you have the on-balance sheet, off-balance sheet items, asset and liability alike.
Great. That's a really good introduction to the financials of a bank. You realize they're quite different from the normal kind of institutions that you deal with out there because the customer deposits are basically a liability for them, and loans and advances are the assets for the bank. What are the kind of quick things that if you were to maybe take hold of a financial statement of a bank that you really pay attention to when you want to see what's the health of a bank looking like?
Yeah, quick one on the balance sheet. You look at how concentrated are the classes of assets. Generally, for us, you'd find we have about 65 to 70% range of our asset is held in loans. When this ratio is very low, it means we are losing an opportunity of making higher income. And that means, of course, we are being inefficient. If you see, for example, a bank here in Kenya giving more to government securities, it means their investment in loans will be lower. So you look at the asset classes. You will also look at the quality of those assets. For the case of loan, you quickly turn into a page where you have the non-performing loan ratio. So when you are giving a loan, of course, you are taking a certain level of risk. And these are usually measured by how many people have so far defaulted. And that is what I'm referring to as non-performing loan. And the lower the number, the better quality the loan book is. So the same will go with if I'm investing in securities, are they government security? Are they local versus foreign government holding? For you to just manage how much risk the bank is taking, how much is being held in cash, because you can see also performance efficiency gains in how much cash a bank is holding. So if it's holding too much cash, you know the risk of losses are greater, and also they're not earning any income on this cash because they're holding them in vault or in the ATMs. You will also look at other metrics like their capability to generate more cash, because yes, it's fine to have 65% of your asset in loans, but how would you tomorrow satisfy a growing need of a customer if you are not growing your customer deposit? So we look at share growth as something that has to be sustainable. So how are you growing with the competition in your market? So in the case of BK, for example, we have strong market leadership where you have seen us maintain 30 plus across the market share for loans, for total assets, customer deposits, and the shareholders' equity. So you are not only generating more, you are holding it for more business growth, and you are also satisfying your shareholders because they're not asking for this money back too much. So you look at return on equity being key ratios for banks, and that generally has to be above ratios such as your cost of capital, and that's your cost of equity, your cost of borrowing. You want to look at stable margins. So if you are targeting loans and investment in various securities, how much are you paying the depositors? The good balance will mean what you are returning as margin is also strong and it's growing. So that's also something that you've seen, let's say, in the past in the Kenyan market, where there's been interest rate cap. If you have given your depositor attractive interest rate, it means you may not have any margin in terms of profitability and sustaining your operation expenditures. So generally, you look at asset quality, you look at the split and efficient management of your asset weight, and also your margins generally, and how satisfied are your shareholders in terms of return, long-term return that they have, which is the ROE. You'd also look for a listed entity like BK. You look at the performance of their stock trading, and for example, for us being listed on the Nairobi Stock Exchange and the Rwandan Stock Exchange, how are people perceiving our stock? Are they buying, or is completely dormant? And if we are doing very well, you would generally translate into better prices in this market.
Great. That was a really good introduction, at least to banks. And now that you've laid a good ground for it, you can tell us, how did BK Group perform in Q3, looking at some of the key ratios that you've just mentioned in terms of ROE, net income. How was it in Q3 this year?
We've been actually discussing this since last week. Our ROE and margin remain quite strong. So we've had another strong quarter. When you look at quarter two, performance has improved compared to year on year because of COVID challenges that we had this time last year. So we are looking at ROE coming back to the level before COVID, and asset quality actually improving. So our return on average equity, which is the ROE, is now at 18.2. You would see some other banks in the continent at 14% range. So it means our shareholders are getting much more than the shareholders of the other bank. Then you look at our efficiency in terms of return for total assets, our return on average assets, or our return on assets is close to, so in the range of 3.3% to 3.5%. And this is also good comparative when you look at other banks. So how much are you getting in terms of profitability for the asset that you're investing? Asset quality, our non-performing loans now currently at 6.2%. So out of all the loans that we have given to date, or that our client owe us, we have only 6.2% in default. And that, at times, you look at it, not only client defaulting, but also additional information you have to downgrade a client. So 6.2 is single digit. When you compare to other markets at the moment with the 10 plus, you'd see BK performance as quite strong in a market that's growing and has a lot of opportunity. And you look at other key ratios will be NIM. Our NIM, which is a net interest margin, and the difference, that is the difference between our interest income and our interest expense. The margin that we are making currently has been quite stable at around 10.5%. And that means we have strong relationship in terms of the inflows and also what we are paying out to the customer. You look at the recent crisis that did put pressure on liquidity, or we anticipated actually the worst. We were remunerating a bit higher, although at times you cannot go back and reprice your loans. So managing a good liquidity, it means even any excess cash that you have, you are making sure it is working very hard. You're investing them as early as possible and getting the benefits in your income statement quite early on. So we also look at things like cost to income ratio. Cost to income ratio is an efficiency ratio that shows how much we are paying for the income that we are generating. And that, of course, the biggest chunk will be your staff cost. Our cost to income ratio is currently the lowest I've actually seen at 35%. And even when you combine it with our loan loss provision, which is usually measured with cost of risk, we have an elevated cost of risk. So how much we provide for bad loans that I mentioned earlier, which is 6.2%. We have the highest cost of risk at 3.7, coming down from 4.5 in December last year. This, when you combine it with our lowest cost to income ratio, we are still doing much better than our competitors. We are below 60% for these two ratios combined. And when you compare it also with the regional banks, we are doing much better. So we are very happy when you look at efficiency ratio, liquidity ratios, very performing quite well, 40 plus range for liquidity ratios. So that's our total liquid assets on total deposit. So our ability and the confidence that the customer should have today, if they need their money, they know they would have it accessible at no time. It's because we are holding liquid assets to a level of 40%. The regulatory requirement on this was 20%, and we are holding double this level. And the same with another key liquidity ratio, which is your LCR. The regulatory requirement is 100%. We are currently at close to 200%. So we do push for having liquid assets to give comfort to our customers, to serve our customer better, and to pay our obligations. So that's one other things. Asset growth. So to maintain and grow your market share, you need to grow faster than the market generally. Of course, it's way attractive for a market like ours that's still in developing state. BK is doing 28.5%. If you look at inflation level at macro level, we are quite low. So it means generally the banking sector is for the year to date, we've done about 12% growth of total asset. BK returning 28.5 means we're doing much better than the whole market, which can only translate into increased market share. So those basically, I would say, are the highlight for our 9 months. We're increasing our market share. We are targeting new business line. We are revamping and improving our capabilities to serve our client better, and that's in form of system investment, training for our staff, and the likes. So we're looking at coming up with new digital product that will make even sure that those that are currently not our client, because they are not easily reachable, will be reached over the telephone, like you see with the telco models.
With that much liquidity in the bank, though, how do you guys think about in terms of paying dividends to investors? How does that work? And what's your dividend history, and how does that look like going forward?
Thank you. So far, since we initially listed in the Rwanda Stock Exchange in 2011, we pay dividend, or we target to at least achieve an annual dividend payment. And that we've done quite well. I remember it being as low as, I think, 11 francs per share. Today, we are looking at a prospect of doing 26 francs per share for next year. So we're looking at our target being consistent growth. And this is comparable to other market, one. And two, you look at other investment instruments that clients are generally investing in, which will be deposit are remunerated annually. Some are even remunerated quarterly. Securities such as T-bills and bonds have coupon payments twice a year. So it's for you to attract retail in a growing market, growing capital market like ours. You kind of want to have a strong and consistent dividend payout ratio. So in the past, we've been maintaining this within 50% range, reducing it at times when we have the need to grow our businesses elsewhere. We have reduced this to the likes of 30%. Now, this current year, we had no dividend declared for 2020, so we are planning to pay out 50% of the current year. So our objective is our shareholders, like all our stakeholders, have to be happier year on year, and they should be getting higher return, whether you look at it from Rwandan franc perspective or in any, because we have shareholders from different markets, those that are foreign, international, regional shareholders. You want their investment to yield higher return. But in addition to dividend, what shareholders ought to look at most is the value that's being created. So our book value per share has grown significantly. It's now over 300 francs per share. So when you look at what is the value for the shareholders, it's not only what is being traded in the market, but it's also what we owe the shareholders as a capital that is attributable to them at any time in the future.
Maybe one more thing that you could comment about is the gap between the book value per share, which is around 300, and I think on BK trades around 250. So it's trading at below book value per share in Rwanda. What do you think about that gap, and how can that be closed going forward?
Yes, the gap is something that, it's like going to the market. The value is driven by supply and demand. So our book value is generally what you are holding for your shareholders. So you make, good profit this year. You remove your dividend payment. The rest is retained in your reserves for shareholders in addition to what they had initially invested. But the market price is driven by who want to sell and whether there is a buyer. When you have the two, generally don't have to go hand in hand, because one is driven by the pressure in the market. So it will be what investors foresee and what they need. You could find investors desperately need to sell because of other commitment that they have. And if they don't find a buyer at their optimum price, they will have to sell at whichever price the buyer is willing to pay. So the market dynamics are generally driven by supply and demand. And in a market like ours in Rwanda, liquidity is still something that, by liquidity, I mean we don't have many people daily trading in stock. We still see the saving culture is quite low. People prefer to hold T-bills and bonds, which is government security. Their perceived risk is very low. And others are preferring to hold money in their current account because the education about capital market has still a lot of opportunities in it. You compare it to the likes of Kenyan side, where we've seen our price reach its highest at around 40 Kenyan shillings, which translates to close to 400, which was above our book value when you look at it at the time it peaked. Again, this was driven by the demand on the side of the Kenyan market. The more investors interact with the issuer and they get more comfort and they understand more the fundamentals, the price generally goes higher, but it means also the book value may be going in line. The gap may narrow, but the two are driven by different factors.
All right. Maybe one more thing that I wanted to ask is about the breakdown of NPL. So you could also comment a little bit about the sectors that you're more concentrated in the market, the number of subsidiaries you have, and the group's total revenue, where it comes from these subsidiaries. Because BK Group is a holding group, and then you have companies below them. So maybe you could tell us how that works.
Thank you. In terms of subsidiaries, BK Group is a pure holding company, currently listed and consolidate 4 subsidiaries. The largest being the bank subsidiary, in existence since for many years, over 50 plus years. We were mostly a corporate bank. So when you look at segment, you'd have BK has large concentration on corporate segment. However, since 5 to 10 years, we are now looking at retail and SME strategy and fully deploying this for digitization. You have the second largest subsidiary, which is the BK General Insurance. It is still an insurance offering fire, motor, and the likes. Also growing greenfield. So we started the company in 2017. Now returning, very close to, we're now over 10 billion of assets. So the bank has 1 trillion worth of assets when you look at assets for the banking business. The second largest subsidiary has about 12 to 15 billion range. And the most recent addition being BK Capital, which is asset management, brokerage, advisory subsidiary. Still small because it's not heavy on asset holding in terms of balance sheet holding, but managing quite well in terms of asset under management. So you'd see that their asset under management grew year to date by 81%. We manage the MTN listing and the likes. So we are looking at a lot of opportunity in advisory and financial investment. A recent vehicle, that's money market fund, that was set up by BK Capital, Aguka, giving very attractive return at 10% plus. investment available at almost no notice for retail and less than a month for corporate client means this is a subsidiary that has huge potential in the future, going even into the region faster than the other subsidiaries. We have the technologies that really focusing on creating digital ecosystems. By that, I mean most of the transactions that are currently being done manually should be done digitally in the future. To sustain the future, you're looking at how much data sharing is taking place, how much do you know your customer, to offer various products and to bank the volumes. So for us to reach about 90% plus banked population, you really want to think about digitization in a different way. So our subsidiary is looking at going into that space. More at the moment, we've identified 2 ecosystems that we are working on. It's the agriculture, which has almost 2,500,000 farmers that are collecting subsidies for our platform, working with various authorities to get, of course, to leverage on this, to digitize this ecosystem. Then you have also the education system. In the past, you would recall parents going to queue in a bank to make payment for the school fees, to receive results from the schools. You need to go see a teacher. Today, these things can be digitized. You can collect not only data, but also the parent and the student alike have controls, and the school have controls over the various platforms. Internet banking being one of them from the bank perspective, but also, education system also softwares and systems will revamp things. So sales on our subsidiary for tech grew by 51%. So that's a big chunk. When you look at the other question that you had on our NPL by segment, we still have the 2 sectors that we are targeting with opportunities that we see: SMEs and retail. This, by SMEs, I mean small, medium enterprise, and these are where the future is. Generally, you'd find banking them traditionally with them coming to the branch for their deposits. You can't bank the value chain. So there's opportunity in banking, growing the SME numbers to improve asset quality. So NPLs for SME is high because the numbers are still from the traditional banking route. We're looking at digitization to get the larger volume banked and also offer them services that can give us intel in terms of how do we manage asset quality, reduce probability of default, and so forth. On the retail side also, we still get, to underwrite a retail loan, you have to go through a process. Relationship management is quite expensive in terms of close monitoring of retail book performance. So NPLs in these 2 sectors, in these 2 segments, in double digits, when you compare it with large corporate where we have huge volume and their NPL are below 5%. So we are seeing volume as the key growth area in the future. However, within these sectors, banking the value chain for SMEs, and then for retail, offering some digital products that will be driven by data and credit scoring that are digitized, as opposed to looking at a customer who came in the branch and applied for a loan. So in terms of sectors that we are financing, we have a good spread. On the corporate book, you have transport and communication being quite a significant portion at around 18%. You have hotel and restaurant, so that's in the service sectors, close to 17%. Commerce, trade in the 13% range, and other activities like manufacturing, energy, that has huge potential to grow. Agriculture, I mentioned it earlier, that are still in single digits. So we have a good spread in terms of sectors that we are financing, with average around 5 years in terms of term, and mostly concentrated on the large corporate clients.
That's a really good introduction. So 2 questions. Looking through your history, you did a rights issue in 2018 and also tried to do a share buyback. Could you maybe comment on those 2 and maybe lessons and reflections that you have around those?
Yes, you're right. After the initial public offering on the Rwandan Stock Exchange, we looked for liquidity by cross-listing. So we raised capital in 2018, 60 million, and cross-listed on the Nairobi Stock Exchange. Mostly due to the fact that liquidity in our market is still very low. By liquidity, I mean the Rwandan Stock Exchange. We have various investors who are fund managers across the border who could not access our stock in Rwanda due to the level of development. So we don't have a good custodian relationship, because for them to buy, they need to buy for a custody arrangement. And that's generally a requirement from various countries to manage risks. of funds flowing from one country to another. So in Kenya, there were many custody set up. So most of the investors that we're targeting have custody arrangement in Nairobi Stock Exchange, and we could cross list, and they had access to our stock. On the Kenyan side also are well advanced in terms of capital market investment. We are also seeing good interest picking up since the listing. So the share buyback discussion we had in the last year was mostly driven by the fact that COVID hit just after we raised capital. So it means we could not roll over our strategy because of COVID. So we had the lockdown, we had a pipeline that dried up in terms of projected growth in our loan book. And the stock on the Nairobi Stock Exchange, more specifically, was the lowest. We were trading at around 12 Kenya shillings when you compare to the recent high at 40 Kenya shillings. It meant if we were allowed to buy these shares, because we raised on the Nairobi Stock Exchange at around 30 Kenya shillings, it means we are getting it even less than half what the shareholders paid for. We would have held this money as a treasury stock until post-COVID, where we will need the capital back. So that was our intention. However, the current regulation did not allow it. So if you buy your own stock, you need to cancel them. Given that we anticipate to deploy this capital in the near future, we did not proceed with the share buyback. However, it's something that is common in other markets. You can buy stock, hold them for a short period before you go back to the market and sell them as treasury stock. This was not allowed on the Rwandan Stock Exchange. Being the primary, we could not proceed with the action.
A few questions that are coming from the audience. How do you record the fees that customers pay for services rendered, and how big are they as percentage of income on your books?
Our non-funded income, we call it non-funded income to refer to fees and commissions. The two bigger ones will be, when you look at fees will be from the banking subsidiary, will be what we're charging the customer, mostly payment platform fees, and also loan-related fees. But you also have from the subsidiary, you have commission that we are charging, like premiums on the insurance subsidiary and the likes. So we have about 21% of our income at the moment as non-funded. And non-funded is not loans related or deposit, net of deposit. So we have a target to do about 25-30% range. In other markets, you see 40% quite achievable, markets that are quite mature in terms of digitization. They can collect very small fees on a bigger platform in terms of volume of trade. You have good fees generation. For us, we are still developing the market. It's quite difficult to apply the fees because this could hold people outside the banking system. So we are looking at a target of around 25%. But at the moment we are 21, and these are fees from the bank. But another big component, being a market that is a net importer, you have transactions that you deal with in FX. So FX revenue, also a big component of our non-funded income, and that's generally the target is to grow it to a level of 15-20% year on year. So that means a customer who comes today to buy foreign currencies, and the people you buy foreign currencies from, you make a margin, and this is something that you have a target to grow to the range of 10-15% a year.
Do you fund projects? I know like Rwanda is very big on green projects. There's a lot of initiatives around electric vehicles, green investments, and also I think I've seen a couple of electric bikes because the greater environment is very conducive for that in Rwanda. So do you fund some of these projects, or are you very conservative in terms of maybe funding investments like this?
We are definitely not conservative. When you look at opportunities that comes, we structure very unique deals at the moment. So anything that will come in Rwanda, you would find a strong partner in Bank of Kigali. So we would go out of our way to understand how best to structure a product. We don't have to reinvent the wheel. If it has worked elsewhere, if it has been financed elsewhere, we will work with various teams in the company to manage the risk. It's always about managing your risk well, pricing it well, and monitoring after you've deployed the cash for a good return and repayment.
I think at this point, I'd ask you more a personal question, like what kind of advice would you give someone who wants to start out in your profession in terms of being a CFO? What kind of things should they know, and what should they prepare themselves with to get to the level at which you are right now?
Thanks. This is very interesting because I would say If they want to be a CFO, they need to believe that they already know that numbers don't lie and that feelings can change. So when you look at your numbers closely, they generally tell you a story that you can rely on. So follow your passion in terms of, if you're a number person, follow your passion. Go into the details. So attention to details is quite key. When I look at what I've learned, it's like a journey. You start really from the root. You look at the basics, get your basics right, target to do well what you're doing, and the numbers will come out and they'll give you a beautiful story if there is anything beautiful, or they will definitely signal when there are signs of issues and warning coming up. So if you are passionate about number, follow your passion, target to do it well, have the highest level of integrity, and strong leadership is of course key. Walk the talk, get ready to roll up your sleeves and get the work done, as opposed to waiting for it to be done for you.
We have a friend of the show here, Kevin. You had a question maybe or comment?
Yes, thanks, Eric, and thanks, Natalie. I joined quite late. I'm sorry, not sure if this was covered, but I know one of the issues that has been boggling BK is the weighted average cost of capital. Maybe you could talk us through this.
Thank you, Kevin, and welcome on the call. Our cost of capital, you look at it twofold. So we have the cost of debt, because we do have some level of debt, although small. You're looking at long-term finance. The cost of long-term finance is in the range of 8 to 9%. You have the short-term deposit from other banks, also remunerated, and also the cost of customer deposit. I would say on the general liability side, you have a of debt, if you call it debt, including liability for customers, you would go in at around 8%. Then you'd come and look at your cost of capital being your cost of equity to get a weighted average. And generally, the cost of equity, which is something the shareholders pay attention to, and it's generally how well is the return when you look at other opportunity for investment that the shareholders has for their capital. They will start with the risk-free rate, which is in our market around 13%, and add the risk premium based on the institution and the market environment that they operate in. So for us, if you look at risk-free rate of return at around 13, you add maybe a risk premium, looking at the recent borrowing for government, maybe at 6-7%. We generally say for a premium bank like ours would have around 16% cost of equity. So you're looking at weighted, so 18 to 16%, then weighted average coming in slightly lower at around 15-16% range when you compare to your borrowing, so debt finance, and your cost of equity.
Thanks a lot, Natalie. And maybe one more thing. I think we've spoken before, and one of the things that you and BK in general were looking to do is generally increase liquidity. We've gone quite some strides in doing that, and that includes cross-listing into Nairobi. But I know some of your anchor shareholders were looking to sell the stock just generally to increase liquidity. Is there any more, or are there advances on this already?
Yes, there are discussions ongoing. You're actually right. We have been talking about this for a couple of years. The first move was to cross-list. That means opening doors to new relationships across the border, and that has been quite well. It's like early days of dating. We are seeing quite good retail uptake on the Nairobi side. But there are other things that we think should happen to increase float trading between the two markets. So connectivity of the market in terms of, we have the CSD where you hold these shares on the Rwandan side or Kenyan side. If this could be automated in terms of connectivity, it will mean you can actually find a buyer in Rwanda today or a seller in Rwanda today and transact on the Kenyan side, and vice versa. So having real-time connectivity of the exchanges will make liquidity, will be a big plus for liquidity. When you look at our shareholder category, we have long-term investors, so people like pension funds and so forth. They're generally in for the long term, so they don't do day-to-day trading. So having a good mix in terms of long-term and short-term, because the short-term will be the ones that are creating the market, buy today, sell tomorrow. And having more of those, it means tomorrow you will buy when I'm exiting. So basically having some day-to-day arbitrage will also mean better liquidity for the stock, and availability of big block can only be improved when you have good connectivity between the two exchanges.
Maybe a final one on the regulatory environment. Are there any changes or risks?
None at the moment. I see some stability on both sides. We have a rep office a representative office in Nairobi. So we are now in Nairobi meeting various regulators. We have not heard or seen any signal that things are likely going to change significantly. On the Rwandan side, also quite proactive in terms of engagement with the central bank. We try and the development in terms of regulation, when you look at we are Basel II, Basel III compliant. We are quite ahead in terms of implementing this fast, IFRS 9 compliant and so forth. So we don't see any significant change on the regulatory and prudential requirement.
Thank you very much, Natalie. Over to you, Eric.
Thank you.
How does cross-listing work in terms of share price? Is there a discrepancy between the share price in Rwanda and the one in Kenya? And how does that usually look like for you?
Although the volume are still quite low when you compare to our peers, you still see retail coming in and getting out. Again, the two don't have to be the same, although the gap shouldn't be big, because then you get other opportunities or other interests like arbitrage. You can buy here and sell in the other market. But generally, the price in one market is defined by the supply and demand. So if you have more people wanting to sell, generally it means that the price will go down, because the buyer will now know that I have an option of driving the market down. You are desperate to exit, I will offer you lower than the market, and they will go gradually at getting at it. So if a buyer wants to come in desperately because they see opportunity and they cannot find a seller, generally the price will go up, irrespective of the market they're in, because as we said at the moment, there is fungibility. So it will take a couple of days for you to move stock from Rwanda to Nairobi or vice versa. However, it will deter. If, for example, I saw value in BK stock and I want to place an order, if it will take me 5 days to get a buyer to move their stock that they want to sell from the Rwandan side to the Kenyan side, it means by the time maybe they move it, price has moved. So my interest would have moved also. So it becomes one thing that the market should address for you to see real-time movement and an investment choice. At the moment, though, you are seeing buyers and sellers in one market. So for you to sell on the Nairobi side, to sell quick on the Nairobi side, you will have an account on the Nairobi Stock Exchange, and the seller will also sell to you quickly if they have an account in the Nairobi Stock Exchange. And on the Rwandan side, the same. When you have a buyer and seller in the same market, the transaction can close and settle faster. We are engaging with various stakeholders to make these two exchanges connect better and have now transaction flowing from Rwanda to Nairobi almost real time and flowing easily.
I think at this point I can give you to maybe give us your closing words and any final words of advice. We hope to also host you again after Q4. You can still keep giving us this kind of insights into banks' financials. So your closing words, and then we'll be able to close for today.
Thank you, Mokai and the Mwango Capital team, for hosting this. This is the first time for me also to have a call on Twitter, and it has been quite exciting. So I look forward to more discussion in this space, and I like the discussion, the way they've gone. It's quite basics in terms of anyone. You don't have to be an investor in BK to pick interest, and we look forward to doing more in this space. Key thing is hold what you are doing well and keep doing them well until we meet.
Thank you so much. Thank you, Kevin, for coming by. We hope to see all of you on Friday during our normal Twitter spaces. See you on Friday and take care. Bye.